Hi everyone, it's Mark Masterson, CIO and partner at Hightower Naples, coming to you with our mid-year market and economic commentary. And I'm calling this one the pause that refreshes. And indeed it was. It's been a wild year in many ways so far, and we'll take a look at what happened as well as what to watch in the second half of 2025. Let's jump right in. We start as always with the four horsemen, and a little bit of different look to the horsemen this time around. Fundamentals, we're staying neutral. We're just trying to decode the message from the economic data. The hard data is hanging in there pretty well, but the soft data, like the leading economic indicators, some of the sentiment indicators, have softened a bit. So it's unclear exactly where we stand on the fundamentals as we move into the second half of the year, as well as the impact of tariffs and the big beautiful bill, etc. So we'll keep fundamentals neutral. Technical analysis looks bullish. Everything's turned around. Most of the charts look pretty good. So no worries there. The sentiment picture flipped it to bearish. What a wild ride on the sentiment side. Of course, sentiment is a contrarian indicator. So since the equity markets have rebounded and sentiment moved quickly from negative back to positive, we flip it over to a bearish because investors are on an intermediate time frame pretty complacent at this point. And then finally, policy, we keep that bullish. Yes, the Fed remains on hold at the moment to President Trump's dismay. They're not cutting rates yet, but they are signaling they're going to cut a few more times this year. And we certainly know the global picture, the global central banks are easing aggressively. And then on the fiscal side, fiscal spending still at drunken sailor levels. We're running deficits despite the hope with Doge in finding spending cuts. Those don't look like they're going to manifest anytime soon. So we're going to take a look at the four horsemen in the pages that follow, but it's a mixed picture with a couple of positives in technical and policy. I'm going to mix things up a little bit. Normally I start with fundamentals, but instead we're going to look at some of the key themes across the capital markets here. I will tell you it's going to be a bit of an eclectic walk. I'm going to just share those key charts that we're looking at as we start the second half of the year. I hope you find this informative. We'll start with the big picture, keeping score. And again, what a crazy year. So if you look at this page, you'd say to yourself, if you fell asleep January 1 and woke up July 1, you'd look at this and say, what a spectacular year. Really, it's been a pretty easy, nothing's really happened. If you look at the year-to-date numbers, you've got bonds. We know cash is up. We got bonds up healthy. We have stocks up healthy. The S&P's up 6%. International markets are up. We have commodities up. We have hedge funds up. And we have precious metals up. So all in all, it's been at mid-year, it looks like a fantastic year. But we also know that under the hood, it wasn't quite that easy, right? I mean, yes, if you look at the sectors of the S&P, you got a lot of positivity, a couple of negative sectors, which would be normal. But look at the volatility that we had in getting there. It was a wild ride. We had some big drawdowns, 17, 22, 26% in different sectors. All the while, they've recovered. And if you want to see that visually, take a look at this chart. This is the S&P. Now, I think this is a pretty interesting chart because what it shows you, this is a weekly chart, but you can see here's the activities that took place this year in the market. You had the kind of, I would call it kind of self-inflicted wound, the tariff tantrum that took place in April, where the market swooned 20%, and then you have the immediate snapback. And I put the arrow right here because this is the pause that refreshes. Again, we had the 90-day tariff pause that took place right here. In fact, that morning, President Trump tweeted on Truth Social, this is a great time to buy, right before pivoting on the policy. The markets jumped 10% that day, which has to be some kind of a record. Historically, it's a big jump in a single day. And really haven't looked back to get back to even, slightly positive on the year. The other thing that I find really notable about this chart as I put it in here is take a look at this red line. That's the 200-week moving average. And you can see that the 200-week moving average has been the line in the sand for this market. This chart goes back about 7 years. You can see every single decline, even the COVID decline. Yes, it broke the 200, but the liquidity came in from the Fed and fiscal authorities and ramped it right back up. But how many times are we going to test this line? And we did it again this year. So clearly, the trend has been the 200-week moving average is a line that the authorities, if you will, the government, whether it's the Fed or the fiscal authorities, really don't want to give up from a technical perspective. Because again, what took place here was Scott Bessent went into Trump and told him, you need to reverse course. This market's in trouble. The bond market was pushing up in yields to 5%. The stock market was down 20%. They reversed course and the pressure valve was released. It's interesting too, if that same chart, if you look at it, this line has really held going all the way back to the start of this bull market, which was in 2009, the end of the global financial crisis. Same thing, 1, 2, 3, 4, 5, and again, 6 times the 200-week moving average was held. So I find that pretty notable, something to pay attention to as we move forward and see, future market swoons. That level will be one to really watch. So moving on to a few other charts around the equity markets. Rumors of U.S. stocks, dying are overdone. As you can see, this chart shows you that flows have been quite strong into the U.S., where in fact, this is as of the end of June, the third biggest annual inflow into 2025. So certainly there's still a strong appetite for U.S. stocks. While at the same time, take a look at the international markets. It's been a long time coming, but this year has been very notable for the expansion in the international markets and the performance, as you can see, across a number of different international markets, well beyond U.S. performance. Again, it's been a long time coming, as you can see here. The U.S., the World Stock Index, ex-U.S., outperforming the S&P by more than 12% in the first half of this year, which is, you have to go back to 1999 to see that. So I find that to be notable and something that we're paying close attention to. But it does make sense. Because if you take a look at some of these charts that compare how dramatic the outperformance of the U.S. has been over the last 10 and 15 years versus international, take a look at this. This shows that U.S. stocks, when we started the year, this is in February, U.S. stocks were at 75-year highs versus the rest of the world. That's very extreme. Let me show it to you another way. This is a great chart. I just posted this in the roundup. This shows how much outperformance has contributed to the U.S. stock market expanding dramatically versus the rest of the world. Let me just share some of this. Total U.S. public equity market cap hit a record 63 trillion, according to Goldman Sachs. That's double the size it was just 5 years ago. In comparison, it took 8 years from 2012 to 2020 for the market to double in value. The U.S. market is now 3 times larger than Europe's, and it's now larger than the combined market size of Europe, China, Hong Kong, Japan, and India. So that's dramatic outperformance, and it can't go on forever. How about this? Emerging markets. They are now underperforming U.S. stocks by the largest margin in more than 50 years. And you can see on this chart, this ratio chart, when it gets to this level, usually you start to see a period where it turns up, like it did there, like it did here. And that means the emerging markets are delivering outperformance versus the U.S. So it's certainly something notable, something we need to watch. And also, because we've had such a strong run, the S&P trades about 50% valuation premium to international stocks. So again, they're cheaper. You've got a better value in the international space. So we're not completely out of the woods. That theme is one that we really are watching, and we've allocated capital there. But I'm watching these. These are my own charts. This is a ratio chart that shows the Vanguard FTSE All World ex-US ETF compared to the S&P 500. As it's moving down, U.S. stocks are outperforming international. You can see once again, we pressed up to that blue line. We're trying to break out. When this starts moving higher, I'll be much more convinced that the international markets are set to outperform. And here's a similar chart, but it's on the cusp of doing that, as you can see. And then here's the emerging markets versus the S&P. So as this is moving lower, U.S. stocks are outperforming emerging. You can see we finally broke through this downtrend and we're moving sideways. And if it starts to move up and breaks that one, we're really going to have a stronger conviction that international markets are going to outperform. So definitely something to watch, and definitely an opportunity emerging in international and emerging markets that's starting to look like it's much more reliable. I mentioned to you the U.S. outperformance. Well, that's been driven largely by tech, as we know, and large cap growth. U.S. large cap growth is on track year to date to deliver the 9th consecutive leading sector size and style performance. It's 8 years in a row. Very, very unusual. But what that does is it forces us to look and say, okay, where are other opportunities? And here's some that we're starting to see. Because of that 8-year outperformance of large cap growth, people have abandoned defensive stocks and value stocks. And now those defensive and value sectors and styles like healthcare, staples, or utilities or defensive are reaching levels that we haven't seen since the tech bubble. So again, as this is moving down, they're underperforming, but as it's moving up, these more defensive sectors are outperforming, and that looks like something that looks highly likely. And then lastly, one other, again, I told you it would be eclectic. One other interesting chart is just the buybacks chart. This is a tailwind for markets, but as Goldman Sachs pointed out, 2025 is set to be the biggest year of buybacks ever, according to Goldman Sachs. So certainly corporations buying back their stock is providing a bit of a tailwind as well. So that's a quick look around the equity markets. Let's take a look around other capital markets. So that I think are offering, or certainly have delivered great performance this year and last year for clients, but I think offer great opportunities going forward. First, let's look at gold. This is a chart I've shown you many times. I highlighted it. Gold had a bull market. It peaked in 2011. It had a 13-year sideways move, and it finally broke out in 2024 from this huge base. Remember, the larger the base, the higher in space. Gold, as it should, is breaking out aggressively. And yet a lot of people aren't believers yet, and they will be, in my opinion. If you take a look at this, how many people know that over a 1-year period, gold outperformed the S&P? Over a 3-year period, gold outperformed the S&P. In 5- and 10-year periods, they performed very similar, as you can see here. And then lastly, on a 20-year period, gold outperformed the S&P. It's been a great performer over time, and it's a great diversifier. And so I would expect that may continue, and here's one reason why. Interesting chart showing the expansion of U.S. government debt and gold. Notice how they are tracking. I will also note, very interesting, July 1st, gold became a Tier 1 asset again, based on the Basel III rules that are now being put in place. So gold is a Tier 1 asset for the banking system, which means that they can hold, U.S. banks can hold gold on their balance sheet and they can lend against it. I think that's basically what that's saying is gold is now becoming part of the monetary system yet again. And that changed back in the 70s when Nixon took us off the gold standard, but that's now been reversed as of July 1st, as gold is now introduced as a Tier 1 asset for the bank. So gold has been a great hedge against rising debt. It's now an asset again on the bank's balance sheets, Tier 1 asset. Beyond gold, how about just the broad commodity sector? Well, again, basing. You notice, remember the big base in gold, bigger the base, the larger in space, or the higher in space. Well, commodities have been basing now since the original rally out of the lows, basing, and looked like they may want to move higher. Here's a better picture. This is the CRB, the Broad Commodity Index. Again, it peaked in the global financial crisis. It had a huge bear market. After COVID, with all the inflation that created, commodities finally broke out of this, and they've been moving sideways in the base. And I suspect and likely would hope that what we're going to see with the broad commodity is an outperformance and a breakout from this base. And again, another ratio chart in terms of the opportunity there. This chart shows the broad commodity index versus the S&P 500. What you see here is when this is moving down, stocks are outperforming commodities. When this is moving up, commodities are outperforming stocks. These green spots are areas that look like tremendous value and opportunity to participate when commodities begin an outperformance cycle. So if you look at these last two, history's playbook is clear. At the 1974 low, which was back here, commodities beat stocks by 500% over 7 years. And at the 2001 low, they outran stocks by 591% over 8 years. What's going to happen here, I suspect, is potentially we could start another cycle where commodities begin outperforming. And they're so due for that. I mean, I've shown you this chart, but over the last 15 years from 2011 through the end of 2024, if you look at all the different asset classes, they did quite well. Here's the cumulative return. There's one that's red. And guess what? It's commodities. So commodities have been the asset class that has underperformed for the last 15 years. And remember, markets tend to be mean reverting, so it'd be reasonable to expect some outperformance from the asset class. Also, if we do end up in a period of stagflationary environment where growth is slower and inflation is higher, kind of like the 1970s, the best performing asset classes during that stagflationary period were gold, commodities, and value, not growth, value over growth. So keep that in mind as potential opportunistic themes. And these are certainly things that we're looking at and allocated to for clients to continue to deliver on the upside, but also hedge on some potential risks and take advantage of potential opportunities looking forward. Continuing with the theme of kind of an eclectic random walk through capital markets, let's take a look at some of those themes in the economy. Again, now we're talking a little bit about fundamentals. So I mentioned to you that we were neutral on fundamentals, and that's because it's a bit of a mixed picture. On the one hand, analysts and the Fed expect GDP to continue to be solid, around 2%, because the hard data hasn't rolled over. It's all looking fairly good. Yeah, we get some mixed pictures, but for the most part, expectations are that growth will continue. On the other hand, we're seeing some of the softer data starting to turn lower. So for example, even JP Morgan CEO Jamie Dimon, he suggested a couple of weeks ago, he said, I think there's a real chance numbers will deteriorate soon in the economic. And part of that may be because he's looking at some of the economic surprises that have turned down, which means that the economic data is starting to come out weaker than it was. So the surprises are to the downside, not to the upside. We're also seeing that in leading economic indicators. We've had the fourth consecutive monthly decline in leading economic indicators, which again, we're looking at, it's fallen 35 out of the last 37 months, and it reached its lowest level since October of 2016. So, the leading indicators have been weak. And what's strange is usually the stock market and leading indicators work together, but now they're going in different directions. So the stock market's pressing up while the leading indicators are turning south. That's a head scratcher in some respects. Despite the stock market's new highs and hanging in there quite well, consumers are still pretty pessimistic. I mean, you can see the levels on the University of Michigan Consumer Sentiment Index are back at levels that we've seen only a few times, even going back to the 80s. So, consumers are feeling a little gloomy. They're still spending. But if you look at this data, I thought this was notable for a couple of things. Consumers feel that business conditions are deteriorating, spiked quite a bit at the end of April and into May. And that may or may not mean anything, except for when I looked at this chart, you notice how anytime we had a big spike in this particular metric, there was a recession. You saw it here, that's this gray line. You saw it here, you saw it there, you saw it there, you saw it there. So they tend to go together. Same thing with the next chart. This is consumers being worried about losing their jobs. Well, we saw a spike, and look at when these spikes take place. Usually they take place around a recessionary period. So is that trying to tell us something? It's hard to tell. And lastly, taking a look at CEOs. CEOs have gotten a little gloomier too. You know, they're kind of turning down here. It's not at recessionary levels like we saw here and here, but it's definitely turned down in terms of CEOs and their certainty and uncertainty. And so there's kind of a discontent there. So it's something to watch. Certainly, we need to watch the economic data in the next quarter and see, do the leading economic indicators roll over? And does that tell us something about where the market's going to go in the latter half of the year? That's to be determined because, again, the hard data has not turned down just yet. So let's move on, take a look at some of the key themes in policy. This is a huge driver. It's been a huge driver. Let's take a look at some interesting charts on policy. First, nothing stops this train. We talk a lot about debt and the deficits and government spending. You can see that's a bipartisan effort. This goes to show you that national debt per president, they all expand it. Doesn't seem to be a Republican or a Democratic thing. We just can't seem to stop adding debt on to our balance sheet and expanding the debt. Deficits definitely continuing to expand. You can see, had a lot of hope coming into the year that we were going to see deficit reduction. We're not really seeing that just yet. I'll show you that. And you can see really the deficit started expanding in 2016, which 2015, 2016, that was Trump's first term. Then we had COVID, really spiked during that period, came back down, but we're continuing to expand, you know, almost 2 trillion last year. And again, as I said, the hope was we were going to see it let up. We had Doge, you know, came in, they were going to find 2 trillion in savings, and then it turned into 1 trillion, and then it turned into 200 billion, and then Elon Musk is running Tesla again, because I think he realized that, you know, the government is run differently than a company, and it's a lot harder to truly make those cuts. You can see the Trump administration really isn't, at this point, we're not really cutting the deficit much. Spending is just the same as it was at the same period for Biden previously. And, you know, through May anyway, we had a big deficit in May, $300 billion up to about 1.36 trillion through May. And more importantly, from a policy perspective, we're really seeing a pivot. So again, all the talk of cutting costs are kind of being thrown out. Even Trump tweeted just the other day, the end of June, for all the cost-cutting Republicans, which I am one, remember, you have to get reelected. Midterms are about a year and couple months away, so we will make it up in growth. So now the theme has gone from cutting costs to let's grow our way out of it. And that is a much harder thing to do. Actually, they're both hard to do. It is hard to cut costs, but growing our way out of it has also been difficult because of the debt load. So policy continues. We have the big, beautiful bill that is, as I record this, is still being voted through. It's back in the House this week. But only thing I want to point out, because I don't know what the ultimate decision will be, I suspect it will get passed. But both sides, the House and the Senate, want to expand the debt ceiling, 4 trillion or 5 trillion. That is policy. As you can see, the debt ceiling always gets expanded. It's flatlined. The debt load is flatlined because the debt ceiling is in place. But once they pass the debt ceiling, this is going to spike back up, probably all the way back up to 38 trillion very, very quickly. And we're going to continue on with that same policy. So I don't think, you know, nothing stops this train. We're going to continue to run deficits. Hopefully they'll be able to find some reduction in that. But that's a big reason why the hard data has not rolled over, because we haven't seen any deficit reduction. Another key policy is interest rates. This is the Fed, and this has really been, you know, quite a circus. You know, it's been a battle really between Jay Powell, the Fed chairman, and he cut rates into the election, but he hasn't cut this year. And again, he's highlighting tariffs and the potential for inflation to flare up. And of course, Trump has been hammering away on Powell. And this is an interesting. This was just on July 1st. Donald Trump wrote Jerome a handwritten note too late, Powell. And he said, as usual, you're too late. You've cost us a lot of money, and you need to lower the rate by a lot. Hundreds of billions of dollars are being lost. And he talks about it here, and he suggests we should be paying 1% interest or better. Well, I'm not sure about that, but there is a case to be made. If you take a look at where the United States is, the Fed funds rate's at 4.5, and we've seen a lot lower rates globally, and I think Trump highlights that quite a bit. And by the way, here's one of the main reasons why Trump is hammering Powell. We have almost $8 trillion of debt that has to roll this year throughout the year. That's going from 2% rates to most likely 4% plus rates. And if we could cut that lower end of the rate, because right now they're rolling this debt into very, very short term, it's causing a problem. When you roll from 2% to 4%, it raises the debt service levels, which again directly impacts the deficits. And you can see that here. So right now, you can see the rise of this red line. That's annual interest expense on our debt. It's reached 1.2 trillion over the last 12 months. We're paying 3.3 billion a day, and we're almost we've surpassed health and defense by 300 billion. It's the second largest government expense. It's just behind Social Security. So Trump is hammering away trying to bring those short-term rates down because that would bring that down quite a bit. You can see it here. This was federal spending during the first 3 months of the Trump administration, and the second largest budget item was interest on Treasury securities. So if you cut the rates, and Trump's what he's saying is if you cut that, this number comes down. Certainly that brings deficits down, et cetera. But I would tell you, take a look at all of these items. There is not much here that you can cut from. It's really, you got to, these are all fixed expenses. So that's what I think Elon Musk ran into in terms of the difficulty. But in Trump's defense, the rest of the world has been cutting aggressively. World central banks have cut interest rates 15 times through May, which is the fastest monthly pace this year. You can see definitely rates are coming down. If you look at the top 10 largest central banks, here we are at the top, at 4+%. Everybody else is down, and heck, even Switzerland just cut its interest rates back to 0. So the rest of the world is in a massive easing cycle, and Trump just wants the U.S. to participate in that. There is some room. You could make the case. I've shown this chart in the roundup. This black line is the 2-year Treasury yield. This blue line is the Fed funds rate. Historically, the blue line follows the black line. So you can see when the 2-year Treasury went up, guess what? The Fed funds rate went up. When the 2-year Treasury went down, it follows with the lag, but the Fed funds rate came down. So right now there's about 0.75 difference between those two, which makes the case that you could certainly cut rates by 0.75 and be within any historical norms. By no means is that what Trump wants. He wants it to come down 2% or even 3%. That would be quite a bit. But there is room to cut. And perhaps Jerome Powell, if you think about that economic data, there is a chance Trump is right and he may be too late. What Powell's looking at is inflation. Inflation has come down. I think Powell is afraid that we're going to go through one of these cycles like we saw in 1972, 1910, 1939, where you had one wave and then a second wave. They all had a second wave. And I think if he cut 2 or 3%, we might be at risk of a second wave. But it's important to note policy can be somewhat predictable. This is Ray Dalio. He said, when countries have too much debt, lowering interest rates and devaluing the currency that the debt is denominated in is the preferred path government policymakers are most likely to take. And that's kind of what we're seeing. It's not free, though, because what we're seeing also is it's being reflected in the dollar. One of the most important charts in the world I've highlighted is the US dollar. And you can see since 1973, we've had the worst first half performance for the dollar, down almost 11%. And the dollar's at a really critical juncture. Here's an uptrend that we've been in. We are at the lower line. So where do we go from here? Does the dollar break down from here? Because if it does, it probably is going to be pretty dramatic. Or does it bounce like it did here and here and here? To be determined. But we can guess, we can take a look at this from other analysis. And one that I do is I look at the euro. Because if you look at the dollar index, 60% of the dollar index is the euro. This is the dollar and the euro overlaid on top of each other. The black line is the euro, the blue line is the dollar. They move inverse, as you can see, and the euro has been surging higher as the dollar has been surging lower. So if we take a very close look at the euro, the long-term downtrend for the euro, this goes all the way back to 2008. Many times it tried to pierce above it and couldn't get above it. We just went above it. So that suggests potentially that the dollar may be moving lower from here, and the euro may be starting a multi-month, maybe multi-year uptrend. That's to be determined, but these are some of the things that we look at to try to get an idea of where do we go and where we're going. And if the dollar is going to move lower, then that could help certain assets. You know, again, that could be a trigger to help commodities and precious metals and other real assets. Another thing that we're looking at is 10-year Treasury yield, but this has really been more in a sideways chop, and it's we've had a couple of scares where the yield surged higher. Here it got all the way to 5% before it turned down. Here we got up to 4.8, turned down, 4.8, turned down, 4.6, turned down, and now we're kind of moving sideways. Are we going to move lower to the low end of the range or to the upper end of the range of 5%? Don't know. If we have an economic contraction, if the economy rolls over, I suspect this goes lower. If the economy stays strong, Fed cuts rates, and inflation starts to rise, then this probably goes higher. So these are some of the things that we're going to be watching. So moving on to the final section, key themes. These are just some of the risks, some of the things that we're highlighting to keep an eye on as we move into the second half of the year. One, again, Bridgewater, Ray Dalio and his team, they did this chart. I just don't think it's very difficult to get much better than what we've seen the last 15 years. What they did was they looked at the stock market since 1970, and they looked at rolling 15-year performance. And the period from 2010 through 2024 was literally the #1 period since 1970. So the market's had a great run, and it's hard to get much better. So we need to be prepared to have perhaps a different dynamic as we move forward. It's also not a cheap market. I've shown you this different ways, but you know, from a historical perspective, no matter which of these metrics you look at, we're pinned towards the more expensive side of things historically. And usually when you get all of these things combined that are high historically, it tends to be periods like we saw in 99, 66, 29, others like today, that could be periods where you're entering a window where the market could turn lower. As I said, it's not an inexpensive market. We're at a 22 times PE, forward PE for the S&P 500, which even over the last 20 years is very expensive relative to the average. So keep that in mind, because if you look at the historical data around markets, when you get to a point where you're at a 22 PE, the forward 10-year returns for the market tend to be pretty flat. So, you know, it's always much better to buy when you're at a cheaper market, because then you have great 10-year returns, 20%, versus a more expensive market. Historically, the forward returns are much more difficult. And I think Warren Buffett is recognizing that. If you look at the Buffett indicator, which is the market cap to GDP, which now is at 200%, which is very, very high. It's at all-time highs, frankly. He looked at this and it could be the reason why he's sitting in a higher cash position. Is he fully invested today? No. He's got 30%, 28% in T-bills, which means he's only about 70% invested, and he's waiting for a better opportunity. So valuations matter, but they're not a short-term timing tool. It's more of a big picture tool. And sentiment is very, very high. So because we've had such an amazing run, the last 15 years being the best 15-year period in the market since the 1970s, we have the most allocated to stocks. So that makes good sense. Households, mutual funds, pension funds, foreign investors, according to Goldman, we're at 53%, which is even more than we saw in 2000 during the tech bubble. It's very, very high. So we got to hope that people stay in their equity positions, right? Because that's if the market turns lower, or if we go through a period that where the market doesn't rebound quite as quickly as it has, you're going to start to see people reduce that. That's a risk. It's something to keep an eye open. It's also a very concentrated market. So again, 38% of the S&P is in 10 stocks. That's very concentrated. And usually what that means is there's opportunities other places. Again, we highlighted real assets like gold and commodities as potential opportunities. We highlighted other sectors in the market like value-focused sectors, healthcare, defensive as potential opportunities. And history suggests that when you reach a point where you're at 38% concentration, this shows that when the top 10 concentration is above 23%, well, we're at 38 now, the bottom 490 equal weighted has outperformed 88% of the time over the next 5 years. So it doesn't mean that the market can't do well. You just can't be in the same things perpetually. And that's what we're trying to focus on when we look at the second half of this year and into 2026, looking for opportunities, taking advantage of those that are presenting themselves now, but also looking to where the puck is going to go or what the opportunities are going to be as we move forward. So thank you again for joining me at our mid-year commentary. I know this one went a little bit longer, but there were a lot of things going on and a lot of interesting slides. I hope you found some value in it. As always, you can follow along in the morning roundup. You can reach out if you're not getting that, or you can reach out to David or myself. We're happy to answer any questions or discuss anything that may be on your mind, and we appreciate you very much, your trust and your confidence and your friendship.